today we're going to be going over a JWB property of the week that's brand new construction and only 7 miles from Cecil Airport that has 3,400 jobs. It's a brand new construction home. It is located real close to these high-paying jobs, and it will have a 2 or 3 year lease signed and deliver over 7.6 estimated ROI, 7.6%. Well, I'm not going to be jealous that you were podcasting with another gentleman, Greg, because right now we are live on Facebook for the Thursday edition of the Not Your Average Investor Show. My name is Pablo Gonzalez. I'm your host. With me, as always, the man that they call GC because of his genius concepts, because he generates cash flows, and because he's a great co-host. Also because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
Great to have you here with us as well, Greg. Great to have the family in the house. I already kind of did my roll call, man, but we got everybody here. We got Bill Shields, we got Carl Thompson, we got Leo from California also, we got Greg Stone, we got Jason Comerford joining us from Murrieta, California. I know exactly where that is, Jason, the Inland Empire, man. I know exactly where you're at. Lee Bishop, Tom Albrechta representing Jacksonville, David Gray with a holla. I don't know, was it a holla or is he saying hola to me? I can't tell. If you have the upside down exclamation point, I'll know. But Dean Curry from Ohio, Andrew Barnhill, Eddie Harris from Hotlanta's back. You know, we got the whole crew here, man. This is great. Thursday edition. I want to right now, as we are setting things up, if you want to follow along at home with us and follow along with this property that we're about to show, Marilyn Cotterman just joined from Homosassa, Florida.
Home of the manatees.
Home of the manatees. Julian Kidd is here from the Dominican Republic, the DR, man. That is a beautiful little part of the world, man. I love the Caribbean. And if you want to join, if you want to follow along with the property that we're going to break down, because today is when we do the really tactical X's and O's and investment advice and specific to a property, go to jwbinventory.com. And that is where you're going to find a sheet that I am going to be fiddling with. I'm going to pop it up on screen before we do it, but I just want everybody going there, jwbinventory.com. If you're on a laptop or a computer at home, you want to follow along, do that. Apart from that, as our regulars, as our community knows, this is a completely interactive show. There's 2 ways to interact with us and each other. One is in the chat. When you pop open that chat, there's a little trick. It is defaulted to only speak to me and GC, which I think I'm gonna turn into a rap song, me and GC. And so unless you change the little blue box right above it from panelists to panelists and attendees, you're only talking to us. But we recommend that you change it to panelists and attendees so you're talking to each other, everybody sees you. For example, Jason, you're only speaking to us. Only I can see that you're from Murrieta. Tom Albrechta, only I can see that you're from Jacksonville. If you guys, David Gray as well, if you guys change that little box, then you all get to interact with each other. And last but not least, if you want the question asked on screen, if you want me to ask GC the question, you want to get my take on it, the best place to put that is in the Q&A box. That's a different thing that you pop open on Zoom. And the reason why I asked that, it is just because the chat, as you see, is going to fly around with all of our friends here that are with us, and the Q&A stays in front of my face. I know that you don't see that as a user experience, but it really helps me not to go cross-eyed. And you know, I guess Lee mentioned the Facebook group, right? We have this Facebook group that if you like what we're doing here on the show, you want to hang out with us throughout the week, go to jwbfacebookgroup.com. We got 2,700 savvy real estate investors in there giving you the no nonsense advice that you need. Greg goes in there, he answers stuff as well on the show that doesn't get answered on the show. If we don't get to it, he'll go in that Facebook group and answer it. And
well, let me add one thing there as well. You know, I just posted a question just to kind of get some feel from the group there. And the question was, what future shows do you want to see as a part of the Not Your Average Investor show? So if you guys want to have an impact on future shows that we're going to do, would love for you to be a part of the group. Go there and then just let us know. I saw some really great ideas that Pablo and I were already just hashing out, and they will become future shows. So go to the Facebook group and be a part of it.
I could not agree more. We used to call it the Secret Cool Club. Now that it's got 2,700 people, the secret's out, just a cool club, right? So join the cool club, hang out with us throughout the week. Greg, we normally kick it off with a property, right? So this is where I'm going to tell everybody to go to jwbinventory.com. Let me show you what you'll find on jwbinventory.com. Let me pop open my screen. And in the meantime, all right, this is what you'll see at jwbinventory.com. This is the property that we're going to review today. If you hit this read more here, you go in. Zoom always takes a little bit of extra time. And then down here, it's going to show up that you can download here you'll download the same assessment that we're going to be using on the show. It's a fully interactive worksheet. You're going to see me tinkering with it all day long. Fiddling is what I like to call it. You're going to see me fiddling with it. And I want you to fiddle along with me because you're my friends.
You are quite a fiddler.
I'm the fiddler. I'm the fiddler in the studio. So, Gregg, before we get into 8629 Austin, you sent me this. You sent me a pretty interesting email about what's happening with construction prices right now. You want to talk about it?
Yeah, let's do that. I always love this show for so many reasons, but for one, it's just transparency and just access to real-time information. You guys get to come inside the walls of JWB, and we use this show as a platform to be able to share it with you. This was an email that my team, the CEO of our company, received from our construction team, specifically about building costs. And a lot of times people have been asking about the rise of construction costs, most notably lumber, but it's more than just lumber. This is an economy now where prices are going up tremendously, especially in the housing industry, because there is so much demand for building houses and supply is having a tough time of keeping up. And so as a vertically integrated provider, JWB buys land many years in advance, and then before we actually build the land out, we don't know what build costs are going to be, right? And so it's a risk that we take on. It's not something that the client feels, because JWB is going to bear that risk. We're going to try to build it for the right price, as low as possible, while maintaining quality. And then the client continues to be able to get that passive income and return on investment. So when build costs go up, it's not a risk to the client. It's a risk to JWB that we take on, and we love to do this. This is part of why we are here to provide this inventory for clients, and why we provide this runway. But just real, this is what we just saw. This came across yesterday or the day before, and I just wanted to share it with you. If you're a builder right now, you're seeing this. This is the way it goes. Flooring costs, 6 to 10% increase. HVAC, 6% increase. That's heating and air costs. Specialties, a 20% increase. Cabinets, a 12% increase. Concrete material, 6 to 12% increase. Light fixtures, as of July 1st, a 6 to 15% increase. Well, I'm glad that they waited until July 1st for those. That's really nice. Lumber surcharge monthly, meaning that we don't know how much it's going up. We're just going to charge you more based on the crazy market that it is for lumber right now. And same thing with electrical. Each month we'll continue to send you the monthly framing surcharge as well. So, if you're a business owner and you're building out 600 houses a year and you get this email, this doesn't make you that excited, but that's the reality. Just wanted to share that with you guys. That's what it's like to build houses right now. And again, we do this. We know the risks that go into this. We do this. We built these homes. We are building these homes because this is the only way to get you inventory in this market to meet demand. If all we had to do was to rely on existing inventory, you would be in a tough spot, because you wouldn't be able to buy nearly as many houses with JWB. So it's a cost of doing business with us. We're not exactly excited about it, but just wanted to share that real news with you.
That's the data flywheel that JWB has, and is one of the things that I love talking about on here, right? And it extends to these construction costs and these commodity values and all these different things. Having been in the building construction industry for 15 years, having access to these numbers is a major advantage in general, right? Like, it's not something, I don't imagine that the average real estate investing partner that you're going to find has the same type of data on construction values as JWB does, even though you start $7 to $8 million worth of construction projects every single month. So I see that as an advantage. And I also see in the whole vertical integration scale of things of the real value of JWB being this risk-adjusted return, right? Like, having access to this data, not just on home prices, not just on land values, not just on the economy and what's happening, but also the guts of the asset is another thing that adds to the risk-adjusted return, right? Like, just something I want to call out.
And there is so much risk that a company takes on to be a provider of turnkey rental properties, to make sure that you have inventory to purchase like you do right now with JWB. That's a part of, there's a lot of reasons why you don't see other companies have inventory right now. There's a lot of reasons why you don't see other companies that have an actual office space with 80 plus employees in it. It's because there's a tremendous amount of risk. Now, right, if we do it the right way, we have market insight, we have the resources around us to be able to capitalize on that, our business will fare very well, and we have, and we're able to manage that risk. But I just wanted to give you just kind of some insight into, I mean, can you imagine owning hundreds and hundreds of lots, and then, build costs, which might cost, 120 grand to 140 grand to build a house anyways. And then you get an email like that, and guess what? Costs across the board just went up another 20%. These are real numbers. And this is part of the reason why you don't see many companies do this. They don't have the experience, the bandwidth, the capital, the desire, the appetite to handle it. And it's who we are. We're built to handle this. This is what's necessary in this rapidly increasing home price environment.
Yeah, Greg, and I kind of threw out a number casually there. You start $7-8 million worth of construction projects each month. Is that $7 to $8 million worth of future construction value that gets started, or are you guys spending $7-8 million a month in construction?
Let me knock you down a little bit there. 7 to 8 is a little bit high. We're at about $3 million a month is what we start.
That's way off.
Yeah. Just a few dollars off there, but you just did a great job of making $3 million a month seem really small and insignificant, by the way. Way to go.
But it is $3 million a month in construction spent.
Yeah, absolutely. Between new construction and then also renovations of existing inventory. Yeah, those dollar figures are huge. And what this should communicate to a lot of people, if you're thinking about this and you're an investor, like, you don't really care that JWB does $3 million worth of construction, because at the end of the day, you're in this to build a portfolio of passive income rental properties, and the construction doesn't cost you, right? Like, you don't really care. But let me tell you why you really should care. It's because when you're an owner of rental properties, your biggest pain points are maintenance costs. And when you work with a provider like JWB, who does significant volume for all of those trades that do business with JWB, whether they're the big home builders or whether they're the small, vendor that handles a service call for you on your property, they all get brought in with this idea and track record that they are going to get significant volume. I mean, we have been doing millions of dollars of construction every single month for years and years and years now. It's part of our value to these contractors and these builders. Well, we also bring them in with agreed upon line item pricing. So our prices on the big items and the small items are going to be lower. And for you as an investor, that is a huge advantage for you, that you get to the value and the buying power of that volume on your small little expense. And that's why when you're a client of JWB and JWB Property Management, when it comes to actual costs on your maintenance items, whether they're big or small, they're going to be a lot lower than you could get if you went out and you try to get somebody else to do it yourself. And they're going to be a lot lower than other property management companies around, because no other property management company is starting $3 million worth of construction every single month.
Yeah, man, that makes a lot of sense. You reach economies of scale in price that trickle down to the investor, and you also reach economies of scale in service. And I know that we've talked about it in the past, that it's when there's a hurricane looming and everybody's got to tie down their stuff, or after a storm passes and you need a handyman to come out, Joe Schmo that has 1 or 2 properties out there that calls a handyman, they're going to get put to the back of the chain and they're going to get overcharged. Whereas you having that ongoing workflow of $3 million a month means that you get the best crew out there to check out the roof, and you get it out there tomorrow because you have that pull, right? So
exactly.
All right, man. Well, without further ado, let's get into this property, Greg. What do you think?
Yeah, let's go over to Osteen Street.
All right.
Which is where we were before.
Huh? Yeah, that's right. Go ahead. No, go ahead. Let's go, bro. You got it.
No, I overstepped my bounds. Go ahead. I was just excited about it.
You're sitting here podcasting with other people. Now you want to talk over. I don't know what you're learning on other podcasts. I don't know what they're teaching you on other podcasts, Greg. But listen, we are magically whisked away here to 8629 Austin Street in the 32210. We're looking at this beautiful $190,000 3-bedroom, 2-bathroom, 2-car garage home with an estimated rent range between $1,225 and $1,275 per month. This is clearly a beautiful new construction home with a beautiful blue sky that happens here in Jacksonville just about every single day. No big deal. But this is what you're buying right here. It's this estimated conventional financing total monthly cash flow of $126 and the estimated conventional financing total ROI of 7.63%. Greg, as we always do when we kick off these properties, I want to say two things. One, if you got questions, start popping them into the Q&A. The longer this show goes, the more the questions happen, and we often run out of time. So if you got questions, I'm going to go straight to them. But until we get questions in, Greg, I'm going to start like we always start. What does this estimated conventional financing total monthly cash flow represent?
So $126 a month in estimated monthly cash flow should speak volumes to you. And here's why it should really matter. When you've got a decision with what to do with your money, many times you're evaluating the opportunities out there, and there's just not a lot of opportunities that actually produce income for you on a monthly basis, right? But that's so critical, right? When you put your money in the stock market, most of the time you don't get a dividend. Even if you do, it's a lot less than this. You put your money into that asset and you hope just for stock appreciation, right? Here, when you look at $126 a month, like the number there is not going to change your life, $126 a month. But this idea, this model of investing where you can put money into something and it pays you on a monthly basis over and above what the expenses are, should blow your mind. I mean, that's what I understood 15 years ago when I jumped into this model. It's this idea that I can buy an asset and it pays me every single month in the form of positive cash flow. So much so that I can buy this asset. I can then go and put good debt on it, right? Good debt, inexpensive debt. And I can incur that cost of the debt. And the rental income still pays for that and then some. And that simple idea is why so many people love rental property investing, because you just can't get that in other asset classes. You can't get that in the stock market typically, right? This, at the core of it, is the number one rule of rental property investing, is making sure that you're investing in an asset. A simple definition of an asset is something that pays you every single month. Simple definition of a liability is something that you pay every single month, a bill, right? So when you see $126 a month, don't get so caught up in whether that is $100 a month or $125 or even $150 or whatnot. This should mean that you're buying assets that pay you every single month, that actually produce money in your bank account every single month. And then think about this in terms of what you want to accomplish, because most of you have a goal, a monthly passive income goal, that is going to dictate that you need to own 3 of these or 5 of these or 10 of these or 20 of these. And start to think about how great it is that you have positive income coming in every single month times 10 of those properties or times 20 of those properties, where the alternative would be that you have negative income coming in every single month. You're paying for something every single month times 10 or 20. So it's a game changer that is the crux of, it's really the first threshold of what a good deal is in rental property investing.
Yeah, man, I like how you describe it, the scalability of it, right? Because it is not a liability, because it's paying for itself. It allows you to scale on top of each other the same way that me as a marketer, I think of a self-liquidating funnel, right? Like if I get $1 in for $1 out of everything that I put out there, then I'm just building a list for free, and I can and I can sell to those people. It's the same thing with retirement planning here. If you're, for every $1 you're putting in, you're getting $1.26 out. You can keep stacking those houses on top of each other into your portfolio. Greg, I'm gonna ask you to explain the difference between the cash flow and the ROI, but we got questions, man, and I'm a man of my word. So we're gonna get into the questions right now. Lee Bishop asks, looks like the tax on the property has gone up at $3,000 per year. Sounds high compared to other houses in the JWB inventory. Is this a new area of investment or creeping out of JWB's core 4 neighborhoods?
Great question, Lee. This is not a new area of investment. This is on the west side of Jacksonville. In fact, I believe it was last show. We were featuring a property literally on the same street, on Osteen Street. This is actually one of the most densely populated JWB core neighborhoods. So it is right where, the vast majority of our properties have been since 2006. So nothing new about this. In fact, the $3,000 property tax number is really quite common. If you're looking at new construction properties over the course of this year, which property taxes are updated every single year, it's largely what you've seen as far as annual property taxes. So really not uncommon. What might be throwing you for a loop, Lee, is the difference between a renovated home and a new construction home. New construction homes have higher price points. And when you have higher price points, that is one of the determining factors as what the city establishes your annual property taxes on. So, we love renovated homes. We love new construction homes. They ultimately both get to that same 7 to 9% return figure, which we'll explain in just a minute here. But the way we do it on new construction is a little bit different than how we do it on renovations. And new constructions, you're going to have higher price points. You're going to have higher property taxes, but you're going to have lower insurance costs. And you're going to have slightly lower maintenance costs as well. On the renovation side, you're going to have lower purchase prices. You're going to have lower property taxes. Your insurance costs are going to be higher, and you'll have slightly higher maintenance costs. But at the end of the day, they produce the same risk-adjusted returns for us, so we love them both.
There you go. We're back on Osteen Street. Definitely a familiar neighborhood for you. We got another question here from Miguel Angel Sanudo joining us from Spain. Miguel Angel, good to see you back, man. I haven't seen your name in a couple of weeks, man. Good to have you. And he puts, I see from a 1 to 2 years ago that ROI seems to have decreased an average of about 1%. Is this because the selling prices are rising faster than rent?
Miguel Angel, great observation. And for friends and guests of the show here over the last year, this has been something that Pablo and I have been shouting from the rooftops. It's this concept that prices are going up, rents will not keep up with prices. And what will also happen is property taxes will go up as well as prices go up. And ultimately what that's going to mean is that your cash flows are going to be lower and your risk adjusted returns on investment, including all 5 profit centers, are lower today than they were a year ago. And they were lower a year ago or they were lower 2 years ago than what they were a year ago. This is real. And guess what? It is only going to be accelerated over the course of the next year. You are going to be seeing risk-adjusted returns on investment, total ROIs, go down here in Jacksonville as well as across the country, because home prices are going up faster than the rate of rents. And when home prices go up, that increased your costs of your debt because you had to borrow more money to be able to buy the house. And property taxes go up, and then other things can go up as well. So you're right on point there, and you're absolutely accurate. At one point, about a year ago, returns on investment were about 7 to 9%, but interest rates, so like a year and a half ago, before the COVID effect, interest rates were 5%, 5.25%. And so returns were 7 to 9% at that point, year and a half ago. Then what happened is interest rates went so low, which they are right now. And so the effect was we were able to increase returns on investment up to 9 to even 11%. Well, what you've seen since then is home prices have gone so much up that we're now down to those 7 to 9% returns, even though your interest rates are still incredibly low, lower than 4.25%. And guess what? Interest rates are not going to go down. So what you're going to see from here on out is home prices are going to continue to go up. And that's why I'm really breaking my own mold here. I don't usually go so strong and make very bold claims, but I'm telling you, I believe this with every part of my soul, that right now is the absolute best time to buy rental income properties. And 1 year from now, 2 years from now, it's still going to be a great investment. But the reality is your returns on investment are going to be lower. Your cash flows are going to be lower 1 year from now, 2 years from now than what they are today.
Just to be clear, Greg, when you say that the returns are lower, that means somebody buying at that point are locking in a lower rate, right? Like the house that I bought at the beginning of this year that had a 11% ROI that's going to be at 11% ROI for the duration of that investment. The one that I just closed on that has like a 9% ROI, that's going to be 9% ROI. And by the way, those are real-time numbers. That's 4 months apart of me purchasing. That's that number. And then going forward, when you're opting in, that's what you're locking in, right? It's not that the investment's going to degrade over time.
So answer is yes and no, but I think you're going to like this answer, Pablo. So what Pablo's talking about is when you buy a property at 9% returns or 7.5% returns, like we're talking about here on Osteen, your purchase price and your debt costs are locked in. And so the expectation that JWB has for your property over time is that, call it 7.5% return here, or in Pablo's case, he was able to buy a number of months ago and it was 9% at that point. Like, that's how much it's changing in a very short time period. It went from 9, which all of you had the opportunity to purchase at 9. And I said, hey, it's going to go down. And guess what? It's 7.5 right now. And I'm telling you, it's going to go down again. So it's going to be lower than that 1 year from now. But Pablo, I wanted to scale back one thing that you said as far as locking in returns, right? What I would say is that your expected returns are locked in at 9%. But the really cool thing is that your purchase prices are set because you already bought it. That's not changing, of course. Your debt cost is locked in because you got a 30-year fixed rate loan. So that's not changing. But what can go up to actually help you?
Rent.
Rents, right? As rents rise, right? That can help your returns on investment in a rapidly in an environment where rents are rapidly increasing. You're not locked in at that 9% actual return. There's no cap to it. There's opportunity for rents to go up, which in theory should offset any future property tax increases. And that's going to be something that would really help your return on investment. What's the other big thing that can go up, Pablo? What's that?
Appreciation.
Appreciation, man. So it's not that your returns are locked in. We go into this, and if you even look at our appreciation rate here, we expect 0%. But again, if you put all the things together that I'm saying, home prices are going to be going up, right? When your taxes go up, nobody likes it, but your property taxes going up is a sign that your home prices went up, right? Which is a bigger win for you. It's a better return. I would gladly take significant home price appreciation and an increase in property taxes all day, every day, because my returns on that are much higher. So, your expected returns are locked in at 9%, but there's a lot of things that you will benefit from the longer you hold on to the property in the form of the other 5 profit centers.
Got it. So it's the floor of the return is locked in there, right? But it can still improve.
Well, okay. Again, I wouldn't say floor there too, right? Let's be real. Like, things can happen, right? There's no guarantees in rental property investing. You don't have a cap, you don't have a floor, right? The reason you're doing your due diligence on somebody like us is you want to make sure that we can hit that and beat that expected return on investment no matter which way we get there. So
makes sense.
But you were totally right though.
They got me in the chat. I know I was sweating there for a second. It made me think, man. Let's stay on this angle of ROI here, because we got a couple of follow-ups. David Gray asked, following up on Miguel Angel Sanudo's question, regarding decreasing ROI, how do you view the long-term viability of investment rentals right now? I guess that's kind of what you just answered.
Yeah, I've been investing in rental properties for a long time, and the thing that I have learned is the way to win is to hold on to these assets long term, because you don't have to predict the future, right? You don't have to be Nostradamus when it comes to rental property investing if you buy and you hold in a market for a full market cycle. So my answer to you as far as the long-term viability of a rental property is the same today as it will be 2 years from now, 5 years from now, 5 years ago, in terms of the long-term viability. You're making a decision based on what your return on investment is here today, based on prices and rents. And if that hits your return on investment goal, well, that's obviously a win. But long-term, the game plan is already really sort of known, meaning that if you buy and hold for a full market cycle, you can look back at what previous real estate cycles have produced as far as home price appreciation in your area. And there's a really good chance that your home price appreciation from today forward over the next real estate cycle is going to be largely the same. data point to kind of prove this is long term, since 1991, historically, on average, Jacksonville has appreciated a rate of 4.3% per year on average, 4.3%. If you look back over the most recent real estate cycle of the last 20 years, guess what that home price appreciation rate is on average?
I would guess 4.3%.
There you go. And what happened during the last real estate cycle? Pablo, did we have an abnormality in the real estate world?
I would say, yeah, it was pretty abnormal.
Yeah. So you would think that this theory would be tested more in a place, in an environment where you had the great run up before 2008, the great recession afterwards, and since you've seen values come back to the norm. But if you take all that into account over the last 20 years, we're at 4.3%. And so that's the way real estate cycles work in a specific region, absent of some major shift of livability, of economy, or whatnot. Absent of that, supply and demand works in your favor, along with the fact that real estate tends to go up as a hedge against inflation. It tends to go up along with how inflation works, which generally is around 3%. Over a long period of time, most likely you're going to come and wind up at about a 4% clip for appreciation from this point forward. So when you ask what's long-term viability, the way you win in rental property is the same answer today as it was 5 years ago, as 5 years from now, right? If 7.5% returns make sense for you today as the best risk-adjusted returns for you, absent a home price appreciation, and you expect to hold on for a full market cycle, that's the long-term viability is excellent in my opinion, and it will continue to be.
Makes a lot of sense, man. And then sticking with this long-term viability and ROI, I think we get into explaining the estimated conventional financing ROI, but I'm going to frame it with Greg Stone's question, because Greg Stone asks, could you expand a bit on the 5 profit centers, especially in terms of tax savings? I'm missing something in this regards. As I understand it, if you're not a real estate professional, the amount of tax deductions is sort of limited, isn't it? So maybe you can talk about the total ROI and how the 5 profit centers fit into it, and you can go a little deeper into the tax savings.
Love it. Thank you so much for the question, Greg. So let's talk about the 5 profit centers. So you've got positive cash flow, or otherwise known as net rental income, right? That's roughly that $126 that we just talked about here. This is what's left over after you bring rent in each month minus all of the expenses. So that's your first profit center. You also have principal pay down, which is your resident paying your loan down for you, which is a really wonderful thing. And now I've owned rental properties for 15 years now, so I've seen this over and over again. You wake up 5 years after buying a property, 10 years after buying the property, 15, 20 years after buying the property, and your loan balance, which was once really high, has now been paid down significantly and increasing your equity. So that's a real return on investment there. You've got tax savings, which we'll jump into in just a minute. Home price appreciation is your 4th profit center. We just talked specifically about that, but home price appreciation combined with leverage, with smart debt is like that is your most impactful profit center. And it's one reason why I spend a lot of time trying to teach people the right way to evaluate it. And then the 5th profit center is inflation hedging. And what we're talking about here are 2 things. Number one, home prices and rent prices tend to go up along with inflation. And the reason is because it's a hard asset. And as goods and services, the cost of goods and services around real estate go up, the rent prices and the home prices tend to go up along with it, right? You don't have the same effect on paper assets with inflation, right? A hard asset tends to go up with inflation. And so when we say inflation hedging, we are talking about that in terms of the rent prices and the home prices. And this has been historically how it has worked. But there's an extra part of inflation hedging, which is not so much talked about, but it's so critical. In fact, my business partners and I were just talking about how can we maximize our portfolio knowing that we're going into an inflationary time. And the reality is that when you lock in debt, you lock in what your interest rate is, you lock in what your payment is, and you try to lock it in as long as possible. You have the ability to lock in debt for 30 years right now at, call it a 4.25% interest rate. Like, that's an incredible opportunity. But what many people don't think about is when you go to pay that loan off 10 years from now, your wages should be going up. Maybe not real wages, hopefully they do, but in terms of actual dollars that you're earning should go up just if we're just assuming inflation. Like, so the dollars that you have to pay the debt down, you have more of them, right? I'm not talking about inflation adjusted dollars. I'm just talking about real dollars, right? So you have more dollars, but your debt payment is still the same. Your debt payment is not adjusted for inflation. So it gets easier and easier for you to pay the debt down just because of the effects of inflation, whereas your income earned is affected by inflation, but your expense on the debt is not. So it gets easier and easier for you to pay the debt down the longer you keep it in place. This concept is monumental. And those two things, that's why I love smart debt. It's another reason why I love smart debt. It's because of the effects of holding on long term are so critical and help you create generational wealth, especially when you do it at scale. So I just got into inflation hedging. You can tell I'm passionate about that. We needed to spend some time on tax savings though, didn't we? That was the original question. I'm passionate about all 5 of these.
And overall, I just kind of wanted you to do your usual explanation here of what the total ROI represents, which you kind of said it, right? It represents all 5 profit centers. Really, it represents 3 of the profit centers because inflation hedging isn't really shown here. And we have appreciation rate at 0, and we're going to address that in a second, right? But like, that's the difference in the ROI and the cash flow, right? That you have the profit centers and you have the not regular costs and returns, right?
You're 100% right. I mean, why don't we just show the effects of appreciation coupled with smart debt, since I just kind of teased that a little bit? Why don't we show that here, and then we'll jump into tax savings just to make sure we crystallize the point. I made the point that after a full market cycle here, you're going to look back on this property, and you can look back at each of those 5 profit centers and see what was your biggest impact. Well, you can see here that absent inflation hedging and absent home price appreciation, your total return on investment here is estimated at 7.63%, right? It's really your cash flow here is, I don't know, 1% of it. Your tax savings are 3%, and your principal pay down is 3%. That's how I'm just ballparking. It's somewhere around there. I mean, that's where you're getting to your total return on investment if we're only looking at cash flow, tax savings, or principal pay down. Okay. Now compare those same figures, 1%, 3, and 3, to what I'm going to show you here for home price appreciation. Okay. When we're talking about home price appreciation, many people don't make the connection that when house values go up 4% in a year, that doesn't necessarily mean that's your return on investment from appreciation. When you are using smart debt, you're using other people's money. And the way that you evaluate return on investment is you take, what is my gain? So that 4% gain over how much did I put into the investment? What's my initial investment? And so if we're just running an example here, let's just say that we had a $100,000 property and that market value went up 4% in that year. That means that if you own that property, it went up $4,000. That was your gain from appreciation on that property. But if you only put down 25% there, then you only had $25,000 into that deal. 4,000 divided by 25,000 is actually a 16% return on investment. If you want to follow along at home, just put 4,000 divided by 25,000 on your phone, and you'll see 16% there. So that 16% is really, now assuming you can buy and hold for a full market cycle so you can count on home price appreciation, that is 16% going towards your total return on investment, right? So Pablo, if you wouldn't mind, go ahead and put 4%, 4.3% in for that appreciation rate right there.
Real quick, Greg, right when I do this, please clarify what is a full market cycle, because somebody asked that in the chat as well, so that we know when we can hold this accountable.
Yes, a full market cycle is known to be between 10 to 20 years. And so the reason that it's 10 to 20 years is because if you go back and you look at 10 to 20 year segments over time, what that has shown is that the average home price appreciation rate in your market is very close to what the historically accurate home price appreciation rate is over time. So if you want to buy and hold and maximize your 5 profit centers here in rental property investing, you should be buying and holding for a period of at least 10 to 20 years. And then it's very likely that you're going to see that same historically accurate home price appreciation rate, which in Jacksonville is 4.3%.
So we put in 4.3%. This is a interactive spreadsheet. If you're following at home, bam, you knock it in, and we are at 23.26% total ROI. That reflects that multiplier effect of the four, like multiplying it by four kind of thing of adding that 16% that you just explained.
Exactly. So when you're looking at your total returns here now, and again, we're not counting inflation hedging because that can get tricky for people for us to show and document and quantify and explain and whatnot. I love it, but I just don't even need to put it in the evals. That's why we don't. So we're talking about 4 of the 5 profit centers, and the real return on investment, if you're buying and holding long enough, is over 23%. Now go back to how did you get to that 23%? 1% or somewhere around there came from cash flows. 3% or somewhere around there came from tax savings, and 3% came from principal pay down, and 16% came from home price appreciation when you couple it in while using smart leverage. This is why I want you all to understand how you can use smart leverage to your advantage, because this is how you create generational wealth. This is how you get ahead using rental properties. And that's why I don't really understand when people say, oh, you know what? Listen, I love JWB. I love the team here, but the cash flows are a little bit low for the Jacksonville market. I'm like, if you're buying and holding for a long period of time and you're only looking at cash flows, like you're missing the big picture. You need to look at all 5 profit centers, and home price appreciation coupled with leverage will be the biggest return on investment over a full market cycle.
There you go. So I want to keep us true to the first question, but I want to reference, there is a question in the chat from Herve Francois that says, how would you rank the 5 profit centers from most impactful to least impactful to your overall ROI? And I think you kind of answered home price appreciation being the number 1 if you're in a high growth market, right? Yep. The rest of them, you want to knock them out in ranking on the other 2. Is there a ranking on the other ones?
Let me clarify that a little bit. Okay, I don't think you get into buying rental properties until you know that it's positive cash flow. That's like your entrance to the dance, right? Because I want you buying assets that pay for themselves every single month. I don't want you acquiring liabilities. That's how everybody got really hurt right before the Great Recession. They started to buy assets that did not produce positive cash flow. And positive cash flow mitigates risk, because I don't always know what home prices are going to do 1 year from now, 3 years from now, 5 years from now. There's no way that I'm going to know that. So positive cash flow is like your entrance to the game. Now, in terms of what your best risk adjusted returns will be after a full market cycle, after a 10 to 20 year hold, I'm very confident that it will not be positive cash flow. It will be home price appreciation coupled with using smart debt.
There you go. So then do you want to rank the rest of them in there? Just kind of like,
sure. Yeah. So it would be, well, you kind of know, I positive cash flow is really important. It's not going to drive your highest return on investment though. So, I just want people to know, I don't want you to go and invest just for home price appreciation. But if we're just talking about after a full market cycle holding on, I would rank it this way. What's actually going to produce the highest return on investment would be home price appreciation. Then you're going to have tax savings, inflation hedging, and principal pay down will all be somewhere around the same. And then your positive cash flow is going to be the least impactful. It's going to produce the least most to your overall return on investment.
Yeah, as long as it is positive, right? Like anybody there that's a NFL fan, right? Like I like to break it down like I break down quarterbacks. Like I think if you are a quarterback in the NFL, you need a certain level of arm strength, right? Like you need to be above a certain level, but the guy with the strongest arm doesn't always end up being the best quarterback, right? Like once they have that level, then it comes down to decision-making, accuracy, leadership, and then arm strength, right? Like just because you can throw it through a brick wall, we've seen plenty of quarterbacks with gun like Jamarcus. I'm not going to get too nerdy about draft day evaluations out here. Greg, can you please do, who was that? The original question, what was it?
It was Greg Stone's question, wasn't it?
It was.
Yeah, it's tax savings.
Yeah, Greg Stone. Can you please hook a Greg Stone up, man?
Absolutely.
Can you let him know how tax savings fits in?
Here's how I think about tax savings. All right. So when it comes to tax savings, like we're all in search of deductions, right? We love tax deductions, right? You talk to your CPA, I can't wait to get this tax deduction, right? Some of us just have kids just to get tax deductions, right? So tax deductions are a real thing, right? We love tax deductions, but normally for tax deductions, you have to, you pay something, you pay for something, cash leaves your bank account, and then you get to write it off against your income. So we all love that idea. We want more of them, but the reality is that you had to pay for something and then you get to write it off. And that's a huge advantage because the alternative is I just paid for something, but I didn't get to write it off against my taxes. So tax deductions are incredible, right? In rental properties, you get significant tax deductions just like that, right? You get to write off your interest cost on your loan, your property management fees, any maintenance costs that you had to spend money on, your taxes, your insurance. I mean, you can even write off, and I want you to talk to your CPA about this to do this the right way, but if you plan a trip to go and check out your properties in a different part of the country or go and meet with your property manager, you may be able to write parts of that off as well. So there are an insane amount of tax deductions that you get from rental properties. But that's not all. There's this incredible deduction called home depreciation, building depreciation. And I'm not talking about the market value of the asset. I'm talking just about the tax depreciation of the asset. The IRS knows that things break over time. And so what the IRS says is over 27 and a half years, they're going to let you deduct the depreciation of your building. And the most critical part about this, the reason that so many people love buying rental properties is because this deduction, right? It might be $4,000 or a $6,000 deduction from for the building value on an asset like this. You get that deduction without money having to leave your bank account. It's a non-cash deduction, right? You get it whether you spend any money on things breaking or not. You get that deduction. So it's like this incredible opportunity to get a deduction without having to pay money for it. And that's why it's so much better than your typical deductions that you get out there. It's because you didn't actually have to pay the money, right? You still get that deduction. And what really works well in rental properties is many times, especially in a market like Jacksonville, you'll have positive cash flow that will come in, but this non-cash deduction, this depreciation, will more than offset what your rental income is in that year. And in that case, what you're doing is you're deferring your taxes. You don't have to pay taxes on the rental income that's earned because it's gobbled up with this non-cash deduction. And that's really powerful as you build a portfolio of 5, 10, 20 properties. That's why people love tax saving so much. And to Gregg's question, he asked if you're limited as a passive investor. What I'm describing right there, Gregg, you are not limited by. It's not only available to active investors or to passive investors or to real estate agents or not. Everybody's able to do what I just described there. There are additional advantages if you're an active real estate investor and you can pass some qualifications. There are even better tax deductions that I'm not even going into yet.
There you go. All right, Gregg, we are at 122 and we got 5 questions to knock out. We haven't even talked about the airport that's close by and how much we want to talk about. So let's knock some of this out. We had a couple questions talking about septic, but right now we got Cecil Jamay asks, Gregg, you may have covered this in previous broadcasts, but what is the difference with a property built on a city sewer or septic?
So what's the difference there? Well, city sewer obviously is maintained by the city. A septic tank is required when you don't have access to city sewer on the property. And a ton of properties in Jacksonville do not have access to city sewer. It's very common, especially for new construction homes that we are building. So it's very normal. The difference that you'll see here is that there are some additional costs that you'll see when it comes to septic. And now on new construction, you really don't see that much of more cost. On renovated homes, you do see more cost for a septic tank because here it's a brand new septic system that is just installed for a renovated home, and many times it's been installed many years in the past, and those tend to break down a little bit more. So we increase the cost expectation on renovated homes a little bit more. But for a new construction home, costs are really marginal. And you'll look and you'll see on line 28 here, estimated PBTS and water treatment fees. You can see there that the expectation there is an annual fee of $275 of that. Yeah, so $275. So really that's the difference there for it being on a septic tank. That's the annual service contract along with the water treatment fees that are necessary because we know how the water is in that area and we want to make sure your resident has a good experience there. But the other thing that we should probably highlight there is the warranty program that we have for new homes now that are on septic, which we highlighted.
I'm glad you went there because Dean Curry asked, I see this property has septic. Will this property be enrolled in the tenant paid septic program mentioned on a recent podcast?
Yeah. So yes, the answer is yes. So new construction properties now go under the warranty program that we have with our septic vendors. And so the septic vendor actually is responsible and our goals are aligned for them to maintain this unit. And guess what? The cost of that program for this being under warranty, meaning that if the septic system goes out, the cost of that insurance premium in essence is borne by the resident. It's not borne by you. So this was a big deal that we rolled out probably 3 months ago on the show. Melissa Gillespie rolled this out. She's a part of she runs our property management team and she was on the show. It's such a game changer. And that's one way that we're able to build new construction homes. Septic tanks are required, but continue to keep costs low like we are in new construction here.
There you go. All right. We're going to get into messing with this sheet. And I know that we've had a bunch of people join us since I made the first announcement. But if you go to jwbinventory.com, you can download the sheet and go through the same breakdown that we are about to do yourself, right? So real quick, let's knock out Miguel Angel Sanudo. He's got another question. I see that vacancy rate is now 3% versus 4% before. Is this because now it's fewer days on market?
Actually, your vacancy rate for new construction, Miguel Angel, has been the same. It's been 3%. You might be thinking about a different property that had a slightly different vacancy rate on renovated homes. Depending on certain things, we see either a 4% or a 3% vacancy rate. So I think that's what you're referencing. But for brand new construction, it's been 3% before, and we expect that to be the case going forward. What you guys will see as far as these vacancy and maintenance rate expectations is we're very slow to move those. That's based on this data flywheel of over 2,000 properties that we track data points for over we've been doing it since 2011. So there's a lot that goes into this. It would mean there would have to be significant changes for us to adjust those numbers. So you bring up a really good point that vacancy right now is less than 1% for JWB. We have over 99% of our homes rented right now. You would think that that would lead to a lower vacancy rate. But the reality is that these assumptions need to be in place for the next 10 to 20 years of you owning this. So just because we are in a great time to rent homes right now and our vacancy rate is so low, you're not going to see us try to sort of maximize that, meaning like put a lower vacancy number on here, because at the end of the day, you're going to be owning this for a full market cycle. And that's not the right way to do it. It's not right to be short-sighted in that approach.
Yeah, Miguel Angel brought up a good point, and you bring up a good point that all of these numbers are calculated from real live data points that JWB has. When we talk about this data flywheel, that what we're talking about, if you haven't been on the show before, is the fact that JWB has done this 3,800 times. So they have 3,800 data points of a very similar asset with a very similar risk profile, with a similar return that they have either built, renovated, sold, and managed for 3,800 people, right? So this is something, these all come from real numbers. And like you said, Greg, you don't often change that very much unless the numbers dictate it. And now we're going to dive into the sheet. Robert Brown asks, can you break down the cash flow with 20% down? So Robert, the first thing you do once you go to jwbinventory.com and pop this open, you open up this analysis, conventional financing. First, you know what? I'm going to go back to set this as 0 again so that we're at the apples to apples here.
Mm-hmm.
Turn off that weird thing. You go to analysis, conventional financing. You pop that open. You come here, and instead of down payment, right, you put in, let me zoom in. I'm sure that's got to be small. Instead of down payment at 25%, you're able to just adjust this yourself, 20%, and voila. It adjusts the finance amount, it adjusts the mortgage payment, the down payment, interest rate stays the same on the sheet, and it has a total ROI now of 8.41% as opposed to that 7 and change. Anything to add there, Greg?
It's really cool exercise right there. I hope everybody takes advantage of jwbinventory.com, because that's the point of the show, especially on Thursdays, for you guys to get down and dirty with the numbers and to start to make them your own, to adjust it. You know, the reality is that when you put less of your own money into the deal, you're going to have a higher return on investment. So what you just saw here from the question was, we took that same property, nothing else changed other than the type of loan that you got. Instead of putting 25% down, you put 20% down, and your ROI went from about 7.6% to about 8.4%. That's financial engineering. And we're going to work with you to help you make the right decision on your loan amount, your down payment. That's a part of our process of bringing on any client. So if you have questions about, is a 25% loan right for you? Is a 20% loan for you? How will this affect cash flow? These are great questions. I would encourage you to reach out to my team. And the easiest way to do that is to give us a call, or just go to the website, which is chatwithjwb.com, and you'll be able to set up a time with my sales team, and we'll be able to walk you through exactly how that can impact you.
Yep. So I just put chatwithjwb.com there in the chat. And in fairness, he did ask how it impacts cash flow, right? So the ROI goes up, the cash flow goes down a little bit, right? The monthly cash flow goes down a little bit.
Yep.
So
exactly.
you can do it yourself with the sheet, right? At jwbinventory.com.
Yep.
Cheryl Ann St. John, what a regal name. I really like that, Cheryl Ann. Asks, I did not see mortgage, principal, and interest. Can you explain? I guess we're going back down to this analysis and cash flow kind of as soon as I find my mouse. There it is. Here we go. So what'd she ask? Mortgage, principal, and interest.
Yeah, exactly. I'd say, just to keep it the same, go back and put it at 25% so we can go back to what those numbers were there. Yeah, Cheryl Ann, great question. This sheet definitely takes into account your mortgage principal and your mortgage interest. What you'll do there is, probably if you go to the left side of the sheet and go down, probably column or row 25 or so, I'll show you where it is. Maybe go down a little bit more. Yeah, there you go. So it's row 36. So your mortgage payment is $691, and that would include your principal and your interest payments on this property.
There you go. Let's go back to the summary sheet. And Greg, do you want to talk about, well, we tease this Air Force. I keep calling it an Air Force base. We tease this airport. Let's talk about that a little bit so that we don't just ignore one of the lead topics. But we talked about Cecil Airport being just a couple of miles from the spot. Tell us a little bit about the Cecil Airport and what's exciting about it.
I'm excited. And for everybody who has stuck around to the end of the show, when I was talking to Pablo about this topic, he was like, oh my goodness, this is amazing. His mind started firing. And I think your actual comment was, I got to buy a property on the west side. The west side is where this house is on Osteen. And
I said that plus the fact that I need to buy, like, I've been investing in rental properties. I'm like, at some point I need to buy my own home here in Jacksonville as well, or else I'm going to be priced out of the market.
Yeah. So what I like doing is, we have these 4 key neighborhoods that we invest in. We love all 4 of these neighborhoods, but I like pointing out individual job creators in these neighborhoods. And so, right, if we're talking about Arlington, we've talked about the Port of Jacksonville, Jacksport, or we've talked about the University of North Florida or Jacksonville University, and Southside, we've talked about some of those same job creators, the university system, but we've talked about the St. John's Town Center, which is this huge outdoor lifestyles mall. And we've talked about the north side with the port and the relevance to downtown Jacksonville and Amazon distribution facilities. Well, here on the west side, we've talked about the largest Navy base that we have, Naval Air Station Jacksonville, which is NAS Jax, which has 20,000 jobs. But I haven't talked specifically about Cecil Airport. And I know about Cecil Airport, but I spent some more time just digging into this, and I got more excited about it. So I'll tell you a little about Cecil Airport. Cecil Airport used to be a military airfield all the way back from the 1940s. And in 1999, Jacksonville as a city and the Jacksonville Aviation Authority took over the airfield, and it became known as Cecil Airport at that point. Since then, it really has become this hub of really business travel. So flights leave, there's, let's see, I've got some notes here. 4 runways, flights leaves 365 days a year, and they basically tag Cecil Airport as where business takes flight. So if you're a business person and you've got your own private plane, or you rent a plane, or you want to go and do this, you don't go to Jacksonville International Airport, you go to Cecil Airport. many times, or one of the local regional airports. The thing about Cecil Airport is that you have these really long runways because it was a military airport. And you also have this incredible amount of space. I was looking it up. We have 22 commercial tenants there right now, of which you will know some of their names, mainly government, military, manufacturing, logistics, and whatnot. So there's 3,400 jobs there, and there's so much room to do more at Cecil Airport. And what's coming next is, so like, and I don't even want to speed over that jobs number, right? Like 3,400 jobs right there today to serve really this commercial business community. All right. And this is located 7 miles away from this house on Osteen. So if you're wondering what a big job creator is for you, to have 3,400 jobs, high paying jobs, $60,000 a year jobs, 7 miles away, that's obviously a big answer there.
Which that means tenant, resident supply, right? If we're talking about benefits over features, right? Like it is a bunch of jobs close by means a steady flow of tenants that are going to want to live close by.
Absolutely.
Yeah.
So, I mean, the way I think about Cecil Airport is it is an awesome job creator today as a business community, like airport, right? Small airport, but it's a major job creator for Jacksonville's economy. But think about what's coming next. So Governor Rick Scott, Florida's governor, back in the day here, not too long ago, but what he did is he officially designated Cecil Spaceport as a designated space territory, which basically paved the way over many years now for Cecil Spaceport to become its own opportunity here. And, commercialized space travel is in its infancy, but it's really cool to think about the opportunity we have. Cecil Spaceport is the only licensed horizontal commercial spaceport on the East Coast. And I'm making sure I'm reading for some notes here because I'm still not 100% certain on all the lingo here. I want to make sure I get it right with you guys, but the only licensed horizontal launch commercial spaceport on the East Coast. And so as I've been doing some digging on this and talking with others, what's happening here is you're hearing about like SpaceX, right? You're hearing about like commercialized space travel, like going vertical, like going to the moon, right? Or going to Mars or wherever. We're not talking about this type of commercialized space travel. What we're talking about is horizontal launches to where you need really long runways. And basically, as it becomes more and more normal for companies to basically launch and send satellites into orbit for commercial purposes and sort of go horizontal, they're going to need places to launch that. That's where apparently this industry is going, and they're going to need a lot of space for companies to come in and maintain that. And so that's why Cecil Spaceport was designated as a space territory, and with it being the only licensed horizontal launch a space on the East Coast, this is what's coming next for Cecil Airport / Spaceport. It's this incredible new opportunity that we have to be a significant driver of the economy in Jacksonville, call it over the next real estate cycle. Even though right now it's like this, but the foundation and the structure is built already, and we're super excited about it.
What made me super excited about it, Greg, is amongst other topics that I'm really nerdy about is this comparison that we're headed into. There's all these parallels to the Roaring 20s coming back, right? The Roaring 20s in America was a big economic boon coming out of the back of a pandemic, coming out of the end of a prohibition. And there's all these other things that are happening, right? So we're coming off the back of a pandemic. You can draw these very like straight lines, economic boon lines towards the end, how cannabis is headed as far as being legalized for medical purposes and recreational across the country for however you feel about it. And then there's also the idea that, number one, electrical consumption took a huge leap in the 20s, the same way that with 5G, cellular and data consumption is going to take a huge leap. And then there's another piece, which was commercialized air travel was where only a very few amount of companies and very few amount of like private citizens were doing it. And it took a giant leap in the 20s of the 1900s. And now it seems that that's exactly where space travel is, right? And the idea that there's this one port on the entire eastern seaboard that's going to be able to service this industry, I just see it as this like magnet for this economic boom that's already coming, that already draws parallel to a past one that happened, along with all these correlations. And it also makes me think of the idea that we've had Nat Ford, the head of the JTA, talking about how Jacksonville is uniquely situated to benefit from the autonomous driving vehicle economy, right? So like now these two major logistic things that are very, very stable drivers of the economy that have this high growth curve coming up, and Jacksonville is poised for both. That's when I was like, damn, dude, I got to get me a house. It's huge.
I would, and you've mentioned this kind of this parallel to the roaring 20s, the 1920s and the pandemic and all that. I'd love to read another article about that. If you have an article, I'd love for you to post that in the group, man, because I've heard this from various people. Either my business partner, Alex, was talking about this just independently, total of what you were just saying there. And I've heard it in a few various circles, and there's so many similarities that people are pointing to. It's really quite uncanny. So, and then, this is, I mean, I don't think anybody should invest in this house because of Cecil Spaceport, right? Like this is not the reason that you should be investing in this house or in Jacksonville in general. But you have so many foundational wins from the economy, right? The 3 Fortune 500 companies here. Our largest employer is the military. Population growth is on fire. The latest data hasn't even been released on population growth, but I guarantee you Jacksonville is going to be ranked very high because we were already the 6th fastest growing MSA in 2018. You have all these foundational, the port is the largest container port in the state. We have a world-renowned airport. We have commercialized rail is CSX, which is a Fortune 500 company, which is headquartered in downtown Jacksonville, right? 94 million people are reached by ground or rail from Jacksonville within a day, same day service to 94 million people, which is why Amazon has come here and built 9 to 10 distribution facilities. So like you have all of this amazing foundation, but you have a few of these things that are like big hitters too, like could dramatically change the landscape of Jacksonville's economy overall. And that's where I would put Cecil Spaceport. It's a cool thing to talk about. I'm pretty jazzed about it, just reading more about it. I know Pablo is too. It's not the reason to invest, but man, how cool is it to have some amazing big opportunities that also, I think if you're looking at the big potential opportunities that are out there, 1, 2, 3 of them are going to hit. And so this may be one of them.
Yeah, I don't want to go down the rabbit hole of something else I'm nerdy about, which is positive black swans and exposure to them, but that's exactly what we're talking about right now. But another great opportunity is our Tuesday show coming up next week, how to save a full month's rent and property management fees. We're going to talk to an investor with JWB, Jeff, who has been with us. I don't know how long has Jeff been with you?
He's been around 4 years.
4 years. Been able to grow his portfolio to the point where he's reached economies of scale, and now he can save a full month's rent per year in just property management fees alone. Super, super smart guy with a bunch of really interesting takes on investing and how he's grown investing and how he's grown his network and how he's gone about it. I think it's going to be a phenomenal show on Tuesday. Hope to see you all there at 12:30. If you like this property and you like what you saw, you like these numbers coming out of Jacksonville, go to chatwithjwb.com, book a call with Courtney, get on and start going down that process so that you can get in on this game. It is, like Gregg said, best time ever to be investing in rental income properties. So I don't take that lightly. I know that I've made a move towards that myself. And join us in the Facebook group, right? jwbfacebookgroup.com. That's the last thing I'm going to ask, right? Chatwithjwb.com. Come check it out. Come hang out with us. Gregg, this was a phenomenal show. We had over 54 people with us today. Never goes on deaf ears here that 54 people took an hour out of their day in the middle of their work week to hang out with us, man. That's a testament to the value that you're putting out there and the knowledge that you're putting out there and what JWB does, man. I'm happy to be a part of this, and I'll leave you to having last words here, man.
I think it's a testament to the community that we all on the show have created. You all bring the fire with the questions that you ask that leads to great discussions. I'm just happy to be a resource for you. I love talking rental properties all day, every day. I would never shut up about it. So this is what I would be doing anyways. I'm just excited I get to share that time with you all, and super excited to be with Jeff on Tuesday. So hope you guys mark the calendars. We'll be with us on Tuesday, and we'll see you in the Facebook group. Until then, take care, everybody.